Hi, everyone. Thank you so much for joining the Powering Growth Navigating Tax Credits in the Energy Industry webinar. We're so excited to have you here. I'm going to pass it off to our fabulous speakers to introduce themselves, but you're in for a really great program.
Great. Thanks, Rachel. Maybe we can go to the next slide and I'll do an overview of the panelists today. But my name is Kyle Seipert, and I co-lead A&M's M&A Tax, Energy, and Infrastructure practice, as well as our tax credit broker-dealer offering. As Rachel noted, I'll be the moderator of today's webinar and am joined by three very distinguished panelists. The first is Amish Shah. Amish is a tax partner at Holland and Knight and co-leads the renewable energy team. Amish has been actively working in the renewable energy tax credit space for over 2 decades across each of the clean energy technologies incentivized under the code. His work includes lobbying support, other advocacy, project development, M&A, tax equity, tax credit transfers, the whole gamut of what a tax partner can do at a big law firm. In addition, Patrick Brown is a member of the transactional risk insurance practice at Marsh, where he focuses on placing tax risks. Before joining Marsh, Patrick was at Big Law and Big Four, where he practiced and represented multinational corporations and private equity clients on a wide range of U.S. federal income tax matters. Patrick is also an adjunct professor at Georgetown, where he teaches a course in corporate income tax and is the co-author of treatises on U.S. tax treaties and transfer pricing. Our last panelist is Steve Schmall. He is a senior director at Alvarez and Marsal in our group, and Steve leads A&M's energy tax credit tax technical team. Prior to A&M, Steve spent time with KPMG and EY's national tax offices, was in-house with Nextera, and started his career as an attorney in the IRS Office of Chief Counsel. So during the next 40 minutes, we're going to tackle three basic items. The first is we want to give an update on current tax reform, how we got here, what next steps are. We're going to then compare and contrast certain key energy tax credit provisions between what is current law, what the House proposed, and what the Senate bill includes. And then we're going to wrap up with non-credit tax provisions in the Senate bill that could impact the energy industry. For each of these, it's not just a regurgitation of what is currently proposed in the laws, but also how we're seeing the market react and what we think are the key takeaways for participants on this call. So given the magnitude of the content we want to cover today, we're not allocating time directly for Q&A. So as you have questions that you want to address, please put them in the chat function. We'll try to monitor and get to them. If we can't, then we'll reach out directly to you to provide a response offline. But to get started, as I look back on my career personally, I think one of the most exciting times for me being an energy and infrastructure focused tax practitioner was when the IRA was signed into law in August 22. And the reason it was so exciting for me is because as I look back at historic tax incentives, I saw four major issues with them. One is there was complexity in actually monetizing the credits. So the IRA gave us transferability. There were years where energy tax credits incentives expired even after the calendar year or tax year ended. Now with the IRA, we had a clear line of sight into a runway through 2032. The credits and incentives were historically focused on developers, but now the IRA provides credits to manufacturers supporting the industry. And finally, the historic credits were focused pretty much on technologies, whereas the new credits effective 2025 are more technology agnostic and more focused on reducing greenhouse gas emissions. Now, that being said, these incentives don't just impact cash tax calculations, but ultimately these incentives feed through to PPA pricing, supply agreements, EPC contracts, and ultimately capital structure and lending profiles. So clearly, to the extent these laws are changed, it can have a ripple effect throughout the entire economy, ultimately down to how much I pay my local utility for my energy needs. So given that potential impact, what we wanted to start off with is, Amish, maybe you could give us an update on tax reform and how you've seen the markets react over the past couple months with the House bill and the Senate bill.
Yeah, and I'm happy to do that, Kyle. And I think, the perspective you just provided is very important that, this isn't just about energy tax credits. It does have a huge ripple effect through the economy. And I think that's important to keep in mind. So how did we get here today? I think it goes back, really to the first Trump administration. In the first Trump administration, President Trump signed into law the Tax Cuts and Jobs Act. And that was a massive tax bill that impacted individuals, corporations, other businesses, had a lot of international tax provisions in it. And that bill was passed along party lines by the Republicans that were, of course, in control at the time. And many of those changes expired or terminated at the end of 2025. Now, as Kyle mentioned, in the interim in 2022, under the Biden administration, we had the Inflation Reduction Act, and I think everyone here really knows enough about that. We don't need to spend a lot of time about the impact of the IRA. But that bill was again passed along party lines, this time by the Democrats, who were in control at the time. Now here we are in 2025. One of President Trump's signature projects in his second term is the extension of the Tax Cuts and Jobs Act from Trump 1. And so there again, it's a very costly bill to extend a lot of those incentives. And one of the things that the bill is doing in order to help pay for some of those extensions is to reduce some of the benefits that were provided in the IRA, at least in the versions that we've seen come out of the House and the Senate Finance Committee. So where are we on the one big beautiful bill? I'm going to call it OB3 in the interest of time. So the House passed a bill on May 22nd. Again, it had significant reductions. We'll talk about those in more detail. Significant reductions in the Inflation Reduction Act provisions. The Senate Finance Committee released their version of the OB3 on June 16th. We'll talk about that as well in a few minutes. And then we're now waiting for the Senate to release the bill anytime now. And I think that folks in this panel had expected that to happen about 10 minutes before our panel, but that has not happened. But we expect that to be released anytime now. Once that happens, it'll go back to the House, and we'll end up ultimately seeing a single bill that'll go to the president for his signature. We get the question about timing. When do we expect that to happen? Well, the president has been pushing for that to happen by July 4th, but if it's not by July 4th, likely soon thereafter. In terms of the market, one thing that's interesting in the market, we'll get into this more in detail as we talk about particular provisions, but the market, has not slowed down at this point. I think people are, trying to get projects in, trying to develop, projects still. We're seeing lots of transfers of tax credits, more than we had even historically over the last couple of years. So the market is still moving on this, but I think once this bill passes, folks are going to be turning around looking at what do they need to do to adjust, and people are already thinking about that. But let's turn to talking about some of the particular issues here, and then turn back to how the markets are reacting to particular changes in the House bill and the Senate Finance Committee bill.
Yeah, thanks, Amish. And I don't think, at least personally, I've seen a downturn in M&A activity as a result of this either. So I think it's across the board been pretty active. But I think one of the major issues, at least we were talking about originally, with the House bill specifically, is what happens if we have sponsors or we buy components from certain parties in specific countries. And I know with the House bill, we were very concerned about the language. So Steve, could you give us an overview of what's called the FIOC rules, and how they apply, and how we think about it with the Senate bill versus House?
Yeah. So the proposals to date generally all include FIOC language, and FIOC stands for Foreign Entity of Concern. And we could spend the entire webcast going through kind of the taxonomy of a prohibited foreign entity, a foreign influenced entity, but for purposes of this webcast, we're going to use the broad term FIOC to cover the entire category. A FIOC is an entity that is owned by or subject to the jurisdiction of a covered nation, and there are 4 covered nations. It's the Democratic People's Republic of North Korea. It's the People's Republic of China. It's the Russian Federation, and it's the Islamic Republic of Iran. If you have the FIAC rules become problematic from a tax credit perspective, either if a FIAC owns or controls a project or a manufacturing process for the 45X credit, or if a taxpayer who's building a facility or energy storage property or who's manufacturing components eligible for the 45X credit sources a sufficient amount of the inputs from a FIAC. And so I think that there was an expectation for a while that there would be a FIAC restriction from an ownership perspective. I believe that it is possible to structure around that. It's not going to necessarily be easy depending on some of these capital structures, especially with some of the entities and conglomerates who have been incentivized to come into the United States due to the 45X credit and due to the domestic content adder on the ITC and the PTC. I think the scarier part, at least in the House bill, was the material assistance limitation from a FIAC perspective. And basically, the material assistance is another way of saying your inputs. And so it's your manufactured products for an ITC or a PTC project, solar, wind, energy storage. We know the list. And then it's your components that are being manufactured for the 45X PTC. The House bill did not have a de minimis exception. That was viewed as unworkable. The Senate Finance Committee draft came back and added in a percentage concept. Think about the domestic content adder for broad strokes, but instead of saying it has to be US sourced, a percentage of your inputs have to be non-FIAC sourced. And so that's the approach that they took in the Senate Finance bill. There's an understanding that this is more workable. The percentages start lower and rise up over the next 5 or 7 years. I think before asking on the implications of the FIAC rules, there are a couple pieces that aren't focused on as much in the press and in the materials that we've seen. One is that to the extent that you overstate a credit due to a FIAC problem, whether it be material assistance or ownership, your statute of limitations would now be 6 years instead of 3 years, and your threshold for a substantial understatement penalty would be 1% instead of 10%. There are rules that say that in the absence of guidance or until guidance comes out on the material assistance piece, taxpayers can rely in part on certifications from suppliers. But then there's also a penalty rule that says that a supplier who signs a certification with respect to FIAC rules on material assistance can itself be subject to a penalty if there is a FIAC problem with the ultimate project or component. So with all of that said, I guess, Patrick, is the FIAC risk, and I think we know the answer, but is the FIAC risk something that project developers and manufacturers can cover with insurance yet?
Yeah, not yet. And apologies if my voice is a little faint. I would just say maybe turn up the volume a bit. I think it's going to be possible. As you alluded to, we are covering in the domestic content space, we are certainly covering those risks with tax insurance. So I think it's going to be something comparable to that. And I mean, moreover, we see, even if we're not necessarily insuring it, we'd see other kind of bad actor provisions in the code. Think international boycott of Section 999. And there are, like, I guess, FIAC light rules in the Section 30D EV credit space. So I think it's something that we're going to adjust to, just like we adjusted in the tax insurance market for domestic content. And quite frankly, even prevailing wage and apprenticeship rules, where none of us were labor lawyers, but we're gonna get there. And I think we'll find out what kind of coverage we'll be able to get once we see the legislation.
Yeah, and thanks, Patrick. And one interesting piece on the material assistance is that to the extent a taxpayer has a supply contract from a FIAC that was in existence prior to June 16th, 2025, which was the date the Senate Finance bill came out, which was the first time it had this, this percentage approach. though that the inputs sourced through that contract do not count for the FIAC percentage test through the end of 2029. And so that does give a little bit of relief, and it does create some winners and losers, as many of the provisions do. But I guess the bill also says that guidance will be issued on with some safe harbor tables for determining your material assistance percentages by the end of 2026. I mean, how do taxpayers and developers think about applying these rules if they were to go into law as they are in the absence of guidance? And how do they think about, the guidance process under the Trump administration?
Well, yeah, I mean, I think there's a huge amount of concern about the FIAC rules as they're drafted currently. Look, when we're dealing with rules like this, we've dealt with other rules that are challenging, domestic content, prevailing wage and apprenticeship, but I think these rules go even beyond that. The way that they're drafted right now and the current versions, make it very difficult for, someone has to comply with those rules to confirm that they can actually meet those because of how they're drafted. And then to also be able to evidence to a counterparty that they actually met those, right? So when we have a developer who's relying on these tax credits and they have to satisfy FIAC rules, and they can't really go through and confirm for themselves that they have met all of these rules without, because they've got to look through layers of folks to figure out where, certain equipment comes from or certain IP or the like. It becomes very challenging, right? And so this is one of those things that could ultimately end up being an end around to terminating a number of these provisions effectively, because if you can't comply with these, or you can't, make sure a counterparty's company can comply with these, then it's hard to build these and it's hard to, monetize the tax credits. So I think a lot of clients are looking at this saying, boy, this really has to be much better. If we're going to have FIAC rules for IRA credits, they need to be much better and much more workable in the final version of this bill. With regard to some of the safe harbors, what we've seen, for example, in the domestic content spaces, we have safe harbors, but they're only for certain technologies. And so the number of technologies that still don't have a domestic content safe harbor, sitting here, 2.5 years after the IRA has passed, and they're having challenges getting the domestic content benefit because they don't have the safe harbor tables. So again, you end up with winners and losers because there's some people who, to the extent that the FIAC rules become workable, you still have the challenge of being able to use the safe harbor tables in the domestic content notices. And the other part is those tables don't really work for FIAC rules related to 45X advanced manufacturing. And so we do have to then wait for further guidance from the administration on FIAC before a number of, you can use, any sort of safe harbor table for certain credits or certain technologies. And it's unclear how long it's going to take for that sort of guidance to come out and how many iterations of it we may need to have before it becomes something that can actually be helpful to the industry.
Yeah, we saw that from a tax insurance perspective with domestic content, as you noted, Amish. People just weren't claiming that domestic content carrot because of the uncertainty of eligibility. Here we've got the reverse, right? We've got a FIAC stick that we're going to be dealing with, and that guidance took a long time in the domestic content space, especially the various safe harbors. So it's going to have to be issued fairly quickly, and that may be a challenge. And certainly the rules as written in either version are going to be challenging.
Yeah, and it seems like now is the time to start looking at supply chain and seeing if there's alternatives and kind of what planning can be put in place to benefit from the rules. But as we look at kind of bill text and language, one thing is it doesn't appear that these will be retroactive in nature. And so a lot of the discussions we've been having with clients is focused on the transition, what I think of as transition language in there, and how do you maximize your ability to qualify for credits given new law. And obviously, part of that hinges around begin construction rules. So maybe we can shift gears. And Amish, can you give us an overview of begun construction rules real quick?
Yeah, no, happy to do that. And these are going to be really important rules, and we want to talk about it because there does seem to be a lot of misinformation out there on how these rules apply. So, begun construction became, was introduced into the tax credit world back in 2009, and starting in 2013, the IRS started issuing notices regarding how to begin construction, and a lot of those of us who were kind of practicing at the time had a lot of conversations with the IRS about why they worked and why they didn't work, and the IRS was kind enough to continue to issue updated notices until they ultimately have a long series of notices defining what it means to begin construction. Um, the begin construction rules have been relevant for a number of things. They've been relevant for, various terminations of the credits over the years, and you have to begin construction by a certain date to get various credits over time. Sometimes those dates got extended. Often they got extended. They've been relevant for energy community if you want to be in the statistical area category, which changes every year. They're relevant for prevailing wage and apprenticeship if you wanted to meet the exception for began construction. And as we'll talk about, they're going to be available. They're going to be relevant in OB3 with respect to certain deadlines that you have to meet in order to be able to get these tax credits. So let's talk about kind of the in a nutshell. Again, this is like a lot of things we're talking about today. We could spend an entire hour or more on this topic, but in a nutshell, began construction. It's a two-part rule. Part one is you have to do either one of two things: the physical work test or the 5% safe harbor. The physical work test requires you to actually begin some physical work on a part of the facility. And generally, that's less of a cost than the 5% safe harbor. The 5% safe harbor requires that you pay or incur 5% of the total project cost. When we talk about total project costs, you have to estimate what the project will cost at the end of the term, and you have to, therefore build in any sort of variance in determining what 5% of the project cost will be in case there are overruns. The key on 5% safe harbor is you have to incur it if you're an accrual basis taxpayer, which means just paying a deposit is not enough for most taxpayers. And that is kind of a key misconception. So make sure you talk to, folks who understand the 461 rules on how to incur an expense if you're going to do the 5% safe harbor. The second part of the test is, after you've done part one, you need to meet the continuous construction and continuous efforts requirement. Now, what that means is you have to have, continuous construction or continuous efforts all the way through to the end of the project. The challenge with that initial rule is that people didn't know what it actually meant. I'm not sure that anyone fully understands what it means today. And so the IRS then came out with a safe harbor that says if you finish the project by the end of the fourth year, after the year in which you began construction, so for example, you began construction anytime in 2024, if you're done by the end of 2028, you will automatically meet part two. And in the industry, I would say the vast majority, almost every project that I've been dealing with since these rules came out in 2009, has tried to satisfy this 4-year continuity safe harbor. And there are a couple of exceptions to the 4 years. Sometimes it's longer, but generally 4 years. And so that's what we generally look to meet here. Something to keep in mind is you just need to be careful about, you've got IRS rules and then you've got market provisions. And so you want to make sure when you begin construction, you both meet the IRS rules and you meet kind of market, kind of what is general market for beginning construction, so that any counterparties to transactions you're involved in, whether it's M&A, whether it's monetization of tax credits, tax credit transfers, are comfortable that you began construction, both in terms of what you've done and how you've evidenced it. So again, a lot there in just a couple of minutes, but again, it's a trap for the unwary. So just make sure you're thinking about how to begin construction. You're working with someone who has great experience with how to begin construction. One question for you, Patrick, is on part two, I haven't, I'm not aware of this, but I want to see, because a lot of the projects in the OB3 may take longer than 4 years and may need to use kind of the facts and circumstances test to go out longer. Have you seen many insurance policies that allow and will cover situations where projects can take more than 4 years to complete?
Yeah, some. I mean, the short answer, of course, is yeah, we can cover it. Obviously, we prefer from an insurance perspective, if you're within the safe harbor, whether it's 4 years or 10 years, depending on the nature of the project, sure. But I do think it's possible to get coverage in that. And we've seen it before. And as you've noted, begun construction has been very important, including from a tax insurance perspective. for many years because you either wanted to be grandfathered into a more favorable tax credit rate, or maybe if it was being phased out or completely, that situation. So we've certainly dealt with it for a lot. Like, for example, on the physical works test, you could get an opinion from council saying, yeah, this should satisfy it. And then there'll be a bring down at the end, basically when the project is at substantial completion, placed in service, to confirm that, for example, continuous efforts were met, even if you were outside of that safe harbor. So the punchline is that, yeah, it's possible.
Great, thanks.
Thanks, Patrick. Thanks, Amish. Why don't we get a little bit more granular on a couple of credits? And the next slides cover off traditional ITC, PTC. So, Steve, why don't you give us an overview of PTC and ITC?
Yeah. So the OB3 would take the new beginning in 2025 tech neutral credits, which is the production tax credit under 45Y and the ITC under 48E. And depending on which version, the Senate version or the House version, it would accelerate the time by which you needed to begin construction on those projects. And under the House bill, it would also accelerate the time by which you needed to place the project in service. So, for example, the Senate bill, it takes wind and solar projects, and it would say that to get the full credit, you would have to begin construction by the end of 2025. To get a 60% version of that credit, so a 30% ITC, you'd be talking an 18% ITC instead. You'd have to begin construction in 26. You'd be looking at a 6% ITC if you begin construction in 27, and then no ITC thereafter for wind and solar. The Senate bill would not harm non-wind and solar projects as much. So key one there is battery storage technology. So if you have a lot of solar and storage projects, you almost end up with a blended ITC rate. But those would still be eligible for the full credit if they begin construction by the end of 2033. It takes away that rule that could, in theory, push that date out if certain emissions thresholds aren't met, emissions reduction thresholds aren't met, but it really takes you out through the end of 2033, which is within most people's forecast periods. I think the biggest kind of tax and non-tax takeaway from whether it's the House version or the Senate version or any version that creates a phase down in the rates is that none of these provisions touch Section 45 or Section 48, which are the ITC and the PTC for projects that began construction prior to 2024. So for those projects, as Amish mentioned in the beginning construction, if you were able to safe harbor those projects, you generally have until 2028 to get them in service. And so there's going to be a market out there where there's a real line between projects that were safe harbored and are eligible for the full credit and projects that weren't safe harbored and now have to face these credit phase downs and potentially a 2028 place in service deadline under the House construct. I think that when you're thinking about pricing a PPA in the market, whether you're an investor, you're an off-taker, or you're a developer, there are some interesting economic questions as to where that kind of market price is going to settle out at. Because if you're not getting the credit and you're developing a wind project, in theory, you're going to have to push that loss of value onto someone else, that someone else may be the off-taker. And so you can end up in fact patterns where somebody who gets a full credit might be able to come in and price slightly below somebody who's not getting a credit. And it almost ends up being a double benefit for the person who safe harbored. So 2024 safe harboring is very important. Whatever the safe harbor deadline is under the bill as enacted is going to be extremely important for that, among many other dynamics. I think we talked about the FIAC rules. We won't go into those again. The one other interesting piece is that it does not, the Senate bill and the House bill, I mean, the House bill doesn't get rid of transferability. I think the House bill is kind of it's a little bit, you're cynical, well, you can't sell something you don't have because the House bill scaled it back so much. The Senate bill would retain transferability as well. It would eliminate the ability to transfer to specified foreign entities. So now you have to look and see if your transferee is a FIAC or is controlled by a FIAC. But I mean, that's going to be the state of play going forward on the electricity generation and energy storage credits, is that there are going to be two or potentially three real categories of developers and projects.
Yeah. Steve, I just might add to that, and that's a great overview. I mean, I might add to that, for projects that began in 2024, to Steve's point, those are going to be valuable because they aren't subject to these reductions. And so you might also see, people who began construction in 2024 and were early stage developers selling those projects. And as they sell those projects, the question is, can the buyer then continue to treat those as having begun construction in 2024? There are transfer rules and began construction notices that do allow you to transfer, what is quote unquote a project, but don't allow you to transfer kind of bare safe harbor equipment. And so again, if people are looking to acquire projects with a 2024 began construction date, in order to get the full credit, we just need to be careful with whether or not the began construction date is going to carry over to the buyer. But yeah, huge news in the Senate Finance Bill on retaining transferability. The number of transactions that we have right now that are allowing people to build projects in the U.S., because of the ability to transfer credits, is absolutely enormous. And so any sort of major restriction on doing that would have almost like the fiat rules would just have a huge impact on the market beyond anything else that's happening in these credits.
Yeah, that's exactly right. Because I mean, from a tax insurance perspective, and Kyle, you hit on it earlier, how people monetize these credits pre-IRA was partnerships or other more complicated structures. And with transferability, it's that much easier to monetize the credits. And of course, we're all going to be seeing what happens with these fiat rules and other kind of limitations on transferability.
And I think, one of the most interesting aspects of the IRA for me, aside from transferability, was the fact that manufacturers could now qualify for credits as well, in addition to developers. And over the next few slides, we have some comparisons for 5 different tax credits. We're not going to go into each one, but Steve, maybe you can just quickly touch on 45X real quick and what the impact of 45X could be. Because, if I think about ITC, PTC, transferability market, 45X has a significant share of the transfer market. And there are good reasons for that. So how is 45X impacted?
Yeah, agreed. Some of the credit transfers in the 45X space are quite striking in their size. 45X, as it's written now, the credit for the eligible components is set to start phasing down in 2030 and then would be completely phased out by the end of 2032. The Senate bill would say, okay, that'll be the same for your battery and your solar components, but for wind components, we're going to have a hard cutoff at the end of 2027. And any components produced and sold after 2027 that are from the wind category, those would no longer be eligible for the 45X credit. The other material change on 45X is for the production of critical minerals, which is eligible for a 10% credit for your direct and indirect costs under the final IRS rules. There's no phase out on that credit under the IRA and current law, and the OB3 proposals would add a phase down that generally by the end of the mid-2030s, you would no longer be eligible for a credit even for your critical minerals, despite the fact that under the IRA, there was no expiration date. So those are that would be a material change for anyone who's relying on that credit to, on source a critical mineral production.
One thing to keep in mind on this is, this credit is bringing in a huge amount of manufacturing into the U.S. I mean, we are working with a large number of clients, as I'm sure others, on this call are, the speakers and participants, a large number of companies, U.S. and non-U.S. companies that have, high-level officials in the company whose job it is to figure out how to invest more in manufacturing facilities in the U.S. And they spend day and night thinking about that because of 45X. So this has been a terrific credit, and it's good to see that, there's been more limited phase downs of this. But even for those, the challenge is that there have been investments that have been made by companies, relying on 45X to produce, for example, wind components in the U.S. And unfortunately, this bill, as least as currently drafted, causes some of those folks to lose the credit much earlier than they expected when they made some of that investment, which is again challenging when you're making investments and trying to incentivize investments in U.S. manufacturing facilities, where we have rules changing kind of in the middle of the game for folks.
Right, and there's no begin construction or safe harboring on your manufacturing facility the way it's drafted now.
Correct.
Yeah, it's either produced and sold, or in the case of critical minerals, at least as proposed, produced in a particular year. And Amish, that's a great point about, people were thinking move the manufacturing here because we're not going to have a phase down. And there's obviously critical minerals right now is evergreen, but we weren't going to have a phase down of these credits starting in basically until 2030. And with at least with respect to wind, we're going to accelerate that.
Yeah.
Yeah.
And I guess one other point, we talked about some areas where the proposed legislation hasn't affected things. That would include, like we talked about, some of the adders are not affected, and also direct pay, at least with respect to these credits, isn't affected. I'm speaking of direct pay for taxable entities. So like 45X, 45Q, for example, are credits for which you can get a direct pay, meaning you can go to the government and get the money back as opposed to selling it on the market. We don't see a lot of people claiming direct pay. I think it's because of the time value of money and people when they think when they're going to get that check from the government. But we have seen coverage placed for entities that are seeking direct pay. And I guess just one point that I've had people ask me is, are direct pay claims subject to joint committee review if they exceed a certain threshold? And at least the answer to that is no. It's not.
So, Patrick, I know that Amish in the discussions talked a little bit about transferability, and obviously we focused on the energy tax credit provisions of the IRA and how they could be impacted. Could you just touch on transferability real quick, and then what should the participants on the call be aware of unrelated to energy tax credits?
Yeah, sure. So I think Steve said it earlier, transferability, at least under the Senate finance version of the legislation, is generally not affected adversely. Obviously, we have to deal with FIAC and that sort of thing. But there are other issues that are going to come up, and most of these relate to TCJA. So you see on this slide, we have a list of items. Are these going to come back? Because basically bonus depreciation was scaling down over time. The ability to deduct interest under 163J, that's gotten harder over time. It used to be a higher percentage and it was off of a larger number. Now we're doing it off of EBIT, and the legislation proposes to basically carve that back to EBITDA, which means there'll be a larger ability to take interest deductions. We see full R&D expensing on this list too, all of which goes to, are taxpayers who are buying these credits, are they going to have as much taxable income to offset if some of these other provisions come back in a more fulsome manner as they existed at the time of post-enactment of TCJA?
Yeah. And Patrick, I mean, it's obviously very interesting in that, we do get focused on the energy, tax provisions of this bill, and there's so much more in it that does affect, that indirectly affects the energy tax provisions of the bill, including all the things that you just mentioned. Right. One thing we have to weigh that against is, even if, there's some folks whose tax liability may be going down based on these other provisions, how many new entrants to the market are there going to continue to be around these credits? So, I think someone mentioned earlier about, maybe using Patrick, about, the challenges pre-IRA with monetizing these tax credits, because we had a limited number of tax equity investors who were kind of playing in that space of helping monetize tax credits. Transferability has brought in companies from every industry who are totally doing things unrelated to, tax credits to come in and buy tax credits. And so the question really in my mind is, you're looking at, potentially lower tax liability of some companies under OB3. You're looking at potentially increased amount of tax credits that are being generated as more companies invest in the U.S. with the IRA, and we'll see how that changes post OB3. But then also increased demand for these tax credits from additional buyers who see that their friends and neighbors are buying tax credits, their competitors, and decide that they also want to take advantage of the opportunities of buying tax credits as well. So all of that kind of goes into bowl, mixing bowl, and we'll have to see how that plays out at the end of the day on, on how it impacts the tax credit transfer market.
And I think that's almost a great wrap up, Amish, for this discussion. When we first started reading the House bill, it did raise some concerns. And as I go through the Senate bill, obviously the Senate version is much more attractive to me than the House version. Although still in certain fact patterns, it may be less than ideal. But if I were to ask you, Amish, and Steve and Patrick, if you could have one item or one wish or something you wanted included in the final bill that's actually signed, what would that be? I'm curious. Amish, you want to kick it off?
So your question is included or excluded? Because if it's excluded, I would say fiat, but included, I think one of the, the bigger challenges is, around the 45Z clean fuel credit. We'd want to see included in that some clarity. So for 45Z, that's one of the credits for which we never received, proposed or final regulations under the prior administration. So I'd like to see more clarity around that. There is a question that comes up around, how the qualified sale rules apply and whether or not intermediary sales are okay. And there's been a lot of discussion around that. There's been some proposal to add language into OB3 that would clarify that, transportation fuel can be sold to an intermediary, which is really what happens in the market. And that would be a qualifying sale under 45Z. I would like to see that included.
Steve, what about you?
I think it would be wonderful if there weren't overlapping deadlines or close to deadlines. Under the House bill, there would have been a place in service requirement by the end of 2028 for the ITC and the PTC, and that would overlap with the 4-year continuous efforts or continuous construction for projects that were safe harbored in 2024 under the prior bill. And when you think about literally getting people on the ground building those projects and having that many projects with a December 31st, 2028 deadline, that there's, at least under the statute, there would be no exceptions. I think that that's just not practical. So the Senate bill, at least since you have until 2025 to begin construction for the full credit, would push it out to 2029. But I'd like to see a recognition that from a practical perspective, this does need to be spaced out.
So Patrick, final words from our insurance representative on the call.
Yeah, I guess I would say, people like certainty. People are planning these projects, moving manufacturing here, thinking they had a longer runway. So I guess a more generous phase out or phase down than is what's in the current legislation.
Yeah, all of that makes sense, and we really appreciate everybody attending today's panel. We do acknowledge there are a number of questions that we have not addressed, so we will be following up with responses directly to those. So thank you, everybody. Thanks to the panelists for presenting, and everybody have a great day.
Thank you.
Thank you.